Hi guys, so the US printed 0.4% month on month, which put the annual inflation rate at 8.2%, which is more than expected. And the market had a bit of a crazy night on the back of that. As we can see here, the stock markets fell on the inflation numbers initially, tagged this 3,500 level brilliantly, and then barreled higher. That 50% retracement is from post-COVID. So this ramp up from COVID lows, the market's fallen 50% now, and a very strong day technically. Further to that, I do think we have seen the lows. Because of this reason. Is what we're seeing is what they call the Christmas rally, which starts in October, and on average, as we can see here, over the last 20 years, on average, the stock market increases month on month through October, November, December, as you get that run into Christmas and people spending money, and Thanksgiving and all those US holidays as well. That Christmas rally is pretty well established, and despite the high inflation and that interest rates are going to get close to 5%, if not more. I think now we've seen the low for the year, and the stock market will rally from here. Won't be straight up, but you'll get that nice slow grind higher as the market runs into Christmas, and you can see that happening over here last year as well. That sort of Christmas rally, there was that October low, and you get that Christmas rally, and I think we're going to see that again this year. US dollar got sold off on the back of the inflation numbers, and that is not to do with bonds. Those who know me know I like the bond market. The bond market is the smart money, but the bond market is uncommitted. Initially, it ran up on the inflation numbers, as to be expected, but then dropped back to being unchanged on the day. So that's really non-committal by the bond market. But with interest rates heading up to 5%, you would expect this market to sort of grind higher. But I don't think we're going to see a major move anymore. I think it will be more a bit of a chop on the bond market, because the 10 years are getting close to where the short end is going to be, so that yield curve is going to flatten out as we get closer to a recession. And so the US dollar, to me, is not following the bond markets. It's more that people are taking cash and putting it into stocks. They're not necessarily buying the US dollar because of higher interest rates, which we're going to get thanks to that inflation number. But people are wanting the stock market more than they're wanting that safety. So I think we're seeing the high in the US dollar, and I think we're seeing the low in the euro. We're probably seeing the low in the Aussie for the time being as well. The pound is an interesting case. Last night, the UK government's, or there's reports that they're going to fold on their tax cuts and fold to market pressures, and so the pound got bid and did very well against all its peers. We can see the pound outstripped all of its peers here. Did beat the euro, beat the NOK, beat the Kiwi, beat the yen, beat the Swiss, beat the CAD, beat the Aussie, and beat the US. On the back of that report, it's not confirmed yet, and if the UK government does carry on with the tax cuts, then you're going to see a lot more chop in the pound. But if they do fold, then the pound will continue to increase in value, and so it'll be a buyer's market. But I'd be a little cautious about jumping on that bandwagon until we see what the report is, because if it's not true, then the market will chop around and it'll just track sideways effectively. So I'd be cautious on the pound. Also be cautious in the US, because the bond market's not showing a reason to be selling the US dollars. It's purely that people are more focused on the stock market now, and I think that the US dollar might chop, but I think I'm not a buyer of US dollars anymore. I'm more on the fence on the US dollar, and I'll be looking to buy assets that or buy products that are that will do better. Right now, I think the Aussie's overextended, and you're going to see a rally in it. Not for any fundamental reasons, just purely technical. And similarly with the euro, I think it's seen the low for the time being, and we'll head back towards parity. Being Friday, being there's still a lot of volatility in the market, I'd probably just take the day off and reassess next week.